Hey everyone, welcome back to Finance Friday, another special edition of Money Girl where I answer your burning money questions. I hope you're doing well. I'm down in Florida where it is already hot and humid. It feels like summer is here. Today I'm going to answer a question that comes from Marcia, who says, I'm 68 and plan to retire at 70. I work for a university and our retirement is with TIAA. They've suggested that I buy an annuity when I retire. I know some experts don't like annuities. How do you feel about them? Thanks for your question, Marcia. And I remember you asked a question about annuities a couple of years ago, so I really appreciate you coming back with this. It sounds like you're getting a lot closer to retirement. And yes, people certainly have strong opinions about annuities. So I'm glad you asked the question. I will review how annuities work, what I think about them, and whether you should consider buying one for retirement. Again, thanks for joining me. I'm Laura Adams, an author, spokesperson, money speaker, founder of the Money Stack newsletter, and host of Money Girl with 43 million downloads. If you're not already subscribed, please do that. That is the best way to make sure you get both of our weekly shows that are coming out on Wednesdays and Fridays. Definitely subscribe to the Money Stack newsletter as well. It's free to do that with lots of good information. If you have a question you want me to cover here on the show, you can do it in a couple ways. One is to call our voicemail line at 302-364-0308, and you can just tell me if you don't want your voice on the show, or maybe you do want your voice on the show. You can also send me an email using my contact page at lauradadams.com, and that's also where you can go and subscribe to the Money Stack. So let's talk about annuities kind of in a broad sense. In their sort of basic form, an annuity is a contract between you and an insurance company that guarantees you certain financial benefits. The idea is that it's shifting risk away from you and onto the insurance company. So the primary risk an annuity reduces or eliminates is running out of money in retirement. This is becoming a problem for more Americans because fewer of us get pensions from employers. That used to be pretty common, but now it is kind of rare. So an annuity may complement your other retirement assets like savings, investments, and any Social Security retirement benefits that you qualify for. And in fact, Social Security is the granddaddy of all annuities because those who qualify get retirement benefits guaranteed by the federal government that are adjusted annually for inflation, and they get those benefits for life. Institutions and professionals sell annuities, so they could be coming from insurance companies, banks, brokerages, and financial advisors. The investment firm that manages Marcia's retirement, TIAA, is one of the largest pension funds in the United States. It stands for Teachers Insurance and Annuity Association of America. They manage retirement accounts for workers in many fields like universities, government, nonprofits, and healthcare. And there are a couple ways you can purchase annuities. You can make a lump sum payment. So maybe you've got a big sum of money. You could just buy it all at once. Or you can make multiple payments over time. And if you do that, they're called premiums. In return, the annuity provider invests your money and typically gives you a series of payments, which is known as annuitization. So there are two basic types of annuities that you should get familiar with. One is income annuities. These give you an income for life or even for a set period in return for a lump sum investment. They're also called immediate annuities because you receive a monthly, quarterly, or even yearly payment based upon your upfront investment. The other main type of annuity is tax-deferred annuities. These offer tax-deferred savings with the option to take withdrawals or to have lifetime income starting at some point in the future. Note that some deferred annuities impose surrender charges or penalties if you withdraw money from them within a certain period after buying them. So let's start with income annuities and how they work. So an income annuity provides income immediately, or at least within a year after you buy it. Again, you make a lump sum, and that's a single premium, and you start receiving an income stream. So let's say you become a widow and you receive a life insurance payment of $1 million after taxes. Let's say you want to create a monthly income stream from that money. Well, you could purchase a fixed annuity instead of investing that money in the stock market. The income you'll receive from the annuity depends on factors like your age, gender, home state, and the interest rate when you buy the annuity. For instance, if you're a 40-year-old female, a $1 million annuity would give you a little over $4,700 monthly for life. So that's right now if you bought it. But if you were 60 years old and you bought that same annuity right now, it would pay out just over $5,700 per month. So you get $1,000 more per month for life. And the reason you get more is because a shorter life expectancy allows you to receive more income from an annuity. So that's why older people typically purchase them. With a fixed annuity, you receive a fixed rate of return on your money for life or for a specific period. No matter what happens in the financial markets, you get a guaranteed, predictable income stream. All right, now let's talk about the other type. How do tax-deferred annuities work? So this is the other broad category where you receive income at a future date, and you make one or multiple contributions during the annuity's savings phase, and then you receive income either as periodic payments or even as a lump sum during the distribution phase. Now, the payout doesn't begin for at least a year after your last premium payment, but it could be deferred by like 40 years if you want. So a tax-deferred annuity is somewhat similar to a retirement account, where you set aside money over time to access it in the future. In fact, you can own a deferred annuity inside a retirement account if you want, such as a traditional IRA, 401k, or 403b, which is likely Marsha's situation. Now, one advantage of a tax-deferred annuity that is not inside a retirement account is that you can contribute as much as you like. Unlike tax-advantaged retirement accounts, annuities have no annual contribution limits. Now, that's unless you own them inside a retirement account. If you own them inside the retirement account, they are subject to the annual contribution limits. So having one outside of a retirement account can be particularly helpful if you're close to retirement and you need to catch up. You need to save a lot. Now, there are tax-deferred fixed annuities. These pay a fixed guaranteed return for a period or for life. While your payment won't change, it may be lower than other annuity options. So, for instance, you can also buy a tax-deferred variable annuity. This is where your return can go up or down depending on an economic index or on the underlying investments that you select. That allows you to benefit from any market growth. The income stream may even have a minimum guaranteed amount, but can increase depending on market performance. And unlike stock market investments, some variable annuities guarantee the return of your original investment at the end of a holding period, like 10 years. However, remember that variable annuity benefits come with a cost because you do have to pay fees when buying one, and I'll talk more about fees in a moment. I mentioned that you can own an annuity inside a retirement account. That's called having a qualified annuity, and it is subject to traditional retirement account rules. For instance, your contributions are tax deductible up to the annual IRS limit. You defer paying tax on the annuity's earnings until you take withdrawals after age 59 and a half, and you do have to take required minimum distributions starting at age 72 or 73. Now, when you own an annuity outside of a retirement account, it's called a non-qualified annuity, and you only have the option to contribute after-tax dollars with that situation. And as I mentioned, there are no annual contribution limits with a non-qualified annuity, so you can invest as much money as you like in one. Even though you pay tax up front on contributions to a non-qualified annuity, you defer paying tax on investment earnings until you take withdrawals after age 59 and a half. And unlike a qualified annuity, you don't have to start taking distributions at any specific age. So you don't get as many tax advantages with a non-qualified annuity. However, it does not come with as many restrictions. So even if you don't own a tax-deferred annuity inside a retirement account, it still acts a little bit like one. For instance, you enjoy tax-deferred growth until you take withdrawals after age 59 and a half. However, taking an early withdrawal from an annuity is typically subject to income tax plus a 10% penalty. And as I previously mentioned, some annuity providers also charge an additional penalty called a surrender charge for taking an early withdrawal. I want to mention annuity riders, since these can be an important part of buying an annuity and also factoring into its cost. Similar to adding a rider to a home insurance policy to protect valuable jewelry, you can add a rider to an annuity to receive optional additional benefits for an added cost. And a few annuity riders include death benefit. This rider ensures that your beneficiary gets any balance in your annuity if you die. There's one called a nursing home rider that helps pay for long-term care either at home or in a nursing facility. For instance, it may double your monthly income or allow you to withdraw more of your annuity balance to cover care costs. And there's terminal illness. That's a rider that allows you to access some or all of your annuity balance without paying an early withdrawal fee or a surrender penalty if you're diagnosed with a terminal illness. So it sounds like a lot of great benefits, right? Marcia mentioned that experts seem to be very opinionated about annuities. They either love them or hate them. I believe that you should be somewhere in the middle. Annuities can be a terrific addition to your portfolio, depending on your assets, goals, and risk tolerance. For instance, if you don't have much saved, let's say you don't qualify for Social Security, or you're very worried about outliving your money in retirement, annuity payments guarantee you an income for life. What's not to like about that? With stock market investments, you could receive higher returns than an annuity. That's what a lot of experts will say. But market returns are never guaranteed. So owning one or more annuities ensures that you survive a long retirement even if the market drops. As I said before, the purpose of an annuity is to shift the risk of losing money or running out of money to an insurance company, not to earn the highest possible return. In addition to knowing that your annuity income won't decline, another benefit is not having to manage complex investments if your cognitive abilities decline in old age. Having a simple financial situation where you just receive a monthly check can comfort a retiree and their family. However, a downside that everyone mentions to the financial security of annuities is that they charge annual fees to cover costs, including a salesperson's commission. Plus, in exchange for guaranteed income, an annuity limits your potential growth in the market. So if you buy an annuity and you have a long life in retirement, you're going to get a great bargain no matter the fees. But if you live a short time after annuitizing, the insurance company typically wins, unless you opt for a death benefit rider. Remember that annuities are the opposite of life insurance. Life insurance benefits when you live a long time. Annuities do not benefit when you live a long time. So they're great for people who have longevity in their family history. The bottom line is that annuities can be a great addition to your portfolio if you want the simplicity of guaranteed monthly income, no matter the opportunity cost. Since there is a lot to consider regarding annuities, including taxes, estate planning, and riders, please consult a qualified financial advisor about whether they fit your retirement strategy. Marcia, I would say you likely don't need an annuity if you have a large nest egg and you're not worried about ever running out of money, no matter your lifestyle or health status. But if you want the peace of mind of guaranteed income immediately after retirement or perhaps sometime in the future, I recommend purchasing an annuity with a portion of your investment portfolio. Carefully review the pros and cons of different annuities and riders with your advisor, and consider getting a second or third opinion if you're unsure about the annuity type or amount that's best for your needs. Marcia, I hope that's been helpful, and I really want to thank you for sending in your questions over the years. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. Our marketing and publicity associate is Davina Tomlin. And our marketing assistant is Cameron Lacey.